Hi, it's Mr Symonds here, and we're looking live. You can see it's 2:27 on Tuesday the 4th of June. In 3 minutes, the RBA will make its decision on the cash rate. Now, cash rate is 1.5%. As you can see here, my expectation is that it will come down to 1.25% when the announcement comes now only in 2 minutes. If you look at this survey here by Bloomberg, a financial information provider, about economists, can you see here that 29 out of 30 economists believe that rates will be cut in 2 minutes to 1.25%. There's only one economist out of this list of 30 surveyed that thinks that they will be kept on hold. And you might say, well, why is the RBA expected to cut rates? So if we switch over to this article on the ABC website, I'll put all the links in the description, that you can see here that the idea is that Australia's economic growth, its GDP, its production remains soft. That there are a couple of things here in terms of the need to give the economy some extra stimulus. So you can see here that retail sales is weak, and that consumption part is so important because remember, consumption is about 2/3 of GDP. Construction work, so important as a measure of investment and create new jobs. That's also pretty weak, and private new business investment also down. So all of these things are sort of giving reason or importance to the need to cut rates further and to really supercharge the economy, or at least give it more of a boost. I don't think one interest rate cut is going to supercharge it. So in terms of what we're about to see, we've still got about a minute. Something else the RBA might be thinking about is, well, what's going to be the impact of those tax cuts, of the government cutting taxes and giving all that money to people in the economy from July, depending on the politicking and when the government can get those measures through. That reduction in tax, putting money in the hand of consumers, that's really going to be a big stimulus. And so will the RBA wait and see, or will it go ahead and do it? So let's have a look. Let's just refresh our website here. Check. Oh, the suspense. So what we've got here is the cash rate. Here you can see 5th of June. It has gone down by 25 basis points. It's now 1.25%. So my forecast was true, but it was a pretty standard forecast. Most economists were thinking that way. Let's have a quick look at the statement. You can see that this is here produced the 4th of June. So at its meeting today, they've lowered the cash rate. This, I think, is really important here. So the board, as in the board of the RBA, took this decision to support employment growth and provide greater confidence that inflation will be consistent with the medium-term target. Okay, so the RBA has cut rates to boost employment, to further reduce unemployment, excuse me, and also provide greater confidence that inflation will move back up into that 2 to 3% target band, because you might have been following that it's been at or pretty much below that 2%, that bottom range of the target band. So let's have a look at what else they say. Another important point here is that the outlook for the global economy remains reasonable, not a huge vote of confidence, although the downside risks stemming from the trade disputes have increased. So the fallout from the China-US trade war could reduce Australia's growth, hence the need to cut rates further. Let's have a look. So the central scenario remains for the Australian economy to grow by around 2.75% in 2019 and 2020. That's okay, but it's not amazing. So we can see here that the main domestic uncertainty, so the main uncertainty in Australia, with the outlook for household consumption. And something that's so important is that household consumption is such a big driver of growth, aggregate demand, so that any slowdown in that will really affect what happens to the economy. Some pick up in growth in household disposable income. That could probably come from the tax cuts. Let's have a look at what we're saying about employment. So this is a good point. Despite these developments in terms of employment growth, there has been little further inroads into the spare capacity in the labour market. So there's been little effort or success in getting some of that slack or unused capacity back into the labour market. So the idea is that the Australian economy can actually get a lower rate of unemployment, that I guess the NAIRU could even be lower. So those are all important points there. Inflation outcomes have been lower than expected and subdued inflationary pressures. I really like subdued inflationary pressures. Some of my students don't love that term. Here we go. The central scenario remains for underlying inflation to be only 1.75% this year, 2% in 2020, and a little higher after that. So the RBA isn't forecasting inflation to get back into its target band in an underlying sense until 2020. So today's decision to lower the cash rate will help to make further inroads into the spare capacity in the economy, will help get all of those unused factors of production back into the economy to be able to reduce unemployment and to get back towards inflation, and that, yeah, it'll keep an eye on things over time. Okay, so here we've seen that the RBA has made the cut, has changed the interest rate setting, and these are the kind of reasons as to why it's taken this action. So the next meeting in July, economists may still be expecting further cuts, but I guess we'll just have to wait and see. All right, thank you very much for watching.